Where are we currently in this credit cycle? Do you want to start?
Okay, great.
Go ahead.
Well, Lisa, first of all, thank you for having us here. It's great to be at this conference, and it's an honor to be up on the stage with Bob, who, as you mentioned, is the co-CEO of Oaktree. And as you also mentioned, the founders of Oaktree actually came out of TCW many decades ago, and this is an incredible firm, great investors, and tremendous leadership. So it's really an honor to be here with you today.
Same here.
So where are we in the credit cycle? Very quickly, I would say we think the credit cycle is quite mature. And we do expect there to be some challenges ahead, both in public and private markets, and we can come back to that. We don't think that necessarily the equilibrium rate is 5.5%, but it's also not zero, which means that by definition, things are going to get more restrictive ahead of us. And then you just have to think about the vulnerability of companies. Clearly, the ones in the IG space that have already termed out their debt are more secure. High yield has shorter maturities. They're going to have to refinance, obviously, eventually at higher rates. And then the most exposed would be those companies in floating rate structures, which we can talk more about. The second point I would make, and I alluded to it, but I just want to emphasize it, is that we do think markets are too complacent now. We don't think the very record tights that we have on credit spreads are reflective of some of the real challenges we have in the economic backdrop. Now, obviously, people are still bidding for credit largely over the last 12 months because you have all-in yield buyers, but ultimately the spread is what gives you protection, and there's not a lot of it now. So we would think there's more opportunity to skew to widen than to narrow, to state the obvious. And then the third point I just want to make is that there is going to be a lot of dispersion here for the reasons mentioned. And we think that's true, again, in both public and private markets. And it should be quite an extraordinary opportunity for active managers to be able to lean into the right places and be liquidity providers and take some pretty incredible returns for their clients.
All very well said and very consistent, I think, with our point of view. You know, if you look at what happened from the financial crisis probably until, 2022, there has been an unprecedented buildup in the amount of debt of all forms, but particularly the forms that, we specialize in. It's grown at a rate well in excess of the underlying economy. And when you've seen that kind of dynamic where debt grows in excess of economic activity, typically that leads to a blow-off or some sort of dislocation over time. That, we would have expected something like that would have already happened. Normally you need some sort of catalyst. We've had a couple catalysts. We had the pandemic, obviously. We had the rate move. Now you're facing a pretty significant maturity wall. So we'll see how the market handles that over the next couple of years. But that maturity wall is only increasing. And, to the point you made, Katie, about dispersion, there are companies that are going to handle it just fine. And there's some companies that are going to fall out. And, over time, we think that'll be an increasing phenomenon.
So both of you seem to suggest that we're late cycle in this credit space, that maybe markets are overly complacent. One thing that's been hard to get your hands around is what does some sort of blow-off look like? A lot of people think about, it must look like a financial crisis akin to 2008. Otherwise, there isn't a near-term corollary in people's minds. Is it just an increase in defaults back to sort of historic norms? How do you sort of view what's ahead?
I'll start and then pass it over to you. The first thing I would say is that we lack the proverbial crystal ball, so we can't tell you if and exactly when there's going to be a recession. I mean, we know that that's the way the world moves, so we'll get that. But I'm interested if you agree, but our view would be that we can get some widening of spreads and some dispersion even in the absence of a recession because of restrictive rates. I don't know.
Yeah, very good point. I mean, you have, as you said, floating rate debt, companies that were predominantly floating rate debt experiencing a lot of stress, burning through, whatever liquidity buffers they may have had. And I guess the different feature of this particular cycle, which we're both well versed in, is the documents are so much worse than they have been historically. And that plays to the advantage of the sponsor. The sponsor is able to delay the day of reckoning. What would have been a default 5 years ago, 10 years ago, is now a liability management exercise, which turns into, an extended sort of a decline for these companies. We think it all ends in the same place, that there's defaults, but it may be more protracted this go around.
There's a lot to unpack there. This idea of, you're talking straight about private markets, and private markets have kind of grown up since the post-financial crisis era and really become something much more mainstream as an asset allocation that people commit funding to. there is this question of, has it gotten frothy within the private markets? Mm-hmm. We're talking about spread tightening in the public markets, but in the private markets, you're also seeing covenant weakening. You're seeing documents maybe get more forgiving and allow people to go on for longer before defaulting. Is that an area that you see a significant amount of the distress to come, or do you think it's just general?
Okay, so just going back to your original question, I think we expect spread widening regardless of whether or not we get a recession. If we get a recession, obviously that will happen more. That's our expectation in liquid markets. And again, big opportunity for alpha there for people to lean in. So just to be clear, we do manage liquid assets as well. At TCW, we have a core plus type mandate. It's the core of people's retirement savings. That's the part of our firm where we would express a macro view. And based on what we've discussed here in that portfolio, we're very liquid, we're conservatively positioned, we're overweight agency MBS, carrying over the index, and we're waiting for one of these events that we just described here, some type of credit event where, again, we can step in, be a liquidity provider, and generate outsized return for clients. We just don't think you're getting compensated now for credit risk. So that answers your question in terms of how we're positioned. And that's what we've done historically at TCW, is wait for those dislocations and lean in. As an example, in 2020, which we alluded to with the pandemic, we put $20 billion of credit to work in a few weeks because that gave us the spread widening opportunity. So we can't tell you exactly. This time will be different. We know that in terms of what the market will do, but the spreads eventually will widen, and you want to be liquid and be able to take advantage of that. Okay, now if I could just say something quickly, turning to private markets, which you asked about, and is there a bubble there? I don't think there's a bubble. A bubble, by definition, requires some massive imbalance between demand and supply, and I think actually those are relatively in check. We know there's going to be demand for private credit because there's demand for people to pick up some spread for sacrificing liquidity. People who have very long-term liabilities are willing to do that, and also they get to print lower volatility. We can debate whether or not that's real, but it is real from an accounting perspective for many of those institutions, like insurance companies. And from a supply perspective, we know it's going to continue to come because banks are withdrawing from providing that credit. So that's going to remain in balance. You have a second part of that question, which is, is there going to be a distress cycle? I think there will, and Bob and I would agree that like private credit as an asset class, most entrants, it's not true of the two of us, so we're statistical anomalies, but 95% of people came into this asset class post the global financial crisis. So actually it really hasn't been through a distress cycle yet. And we don't know exactly what that's going to look like. But you brought up one very important thing that I really wanted to pick up on, which is that, and I know you agree because you guys have been public about it, the documentation has gotten weaker. And actually, private credit as an asset class, the covenant is the asset class. It is the ultimate hedge. It is the thing that is supposed to distinguish private credit from other asset classes. You actually get a do-over. It is the only asset class where the capital provider is able to really dictate terms to the capital user. And if they deviate from those terms, from a performance perspective, you get to take economics. In the extreme, you actually get to take control of the company. And I think what we're going to find is that people gave that away for free. And they did that because they were focused on deployment of capital over the discipline of the process. And what we're going to see in the next couple of years is some accidents related to that. It's not a bubble for the asset class, but we expect there to be a rise in defaults. And I think the main driver of that is going to be covenants. And of course, the secondary one is that we have a math problem because people put capital structures in place with the expectation that rates were going to stay zero, and they didn't. And now math is taking over.
Yeah, all very well said. I mean, there have been three real big dislocations over the last 40 years. One in the early 90s around the Gulf War recession, one around the dot-com blow-up, and then, of course, the financial crisis. All of those were marked by at least double-digit defaults. Mm-hmm. I'm not sure we get to that level this time, but even if you get back to sort of the historical norm for high yield and leveraged loans, which is around 4%, you're going to get a very, very significant amount of activity because, of course, that's operating on a much larger amount of debt than it was, even 10 years ago. I do agree private credit is better underwritten than the syndicated loan market. The syndicated loan market, I think, is the locus of the most egregious stuff that happened. I think that will be very interesting to see how it plays out because I'm not sure everybody is fully aware how bad it can get with some of the documents that have been put in place.
Well, and you said something earlier, Bob, that you think that there are a number of companies that would have defaulted at this point if it hadn't been for how loose some of those covenants were, that are kind of hanging on because of the benevolence of investors who don't want to take the losses yet. I'm extrapolating there. I'm putting words in your mouth. You can correct me. But I'm wondering how much you think that has delayed a credit cycle, how much that has masked some of the distress under the hood that otherwise would have come to the fore in higher defaults and more companies looking for workouts.
If you use that 4% as kind of the historical average, we're sort of in the low twos in high yield and the high twos in loans when you add in what they call selective default, which is where a company undergoes some sort of liability management. That number is generally growing, but it's not spiking. It's just easing up. I do think, again, you're getting to the point of no return, especially for a couple of these floating rate structures where they're bridging themselves by issuing more debt. And at some point, even if rates go down, it's not going to be able to be recovered. But this time around, I think, again, the latitude that sponsors have in the documents, combined with the willingness of those sponsors, because again, if you go back 5 or 10 years ago, sponsors were more reticent to participate in this sort of activity. That's gone. So you have the combination of bad documents with aggressive sponsors, and I think that combination is going to result in a tremendous level of liability management over the next year and a half.
I would just add to that, actually in private credit, defaults went down in the first quarter, which would be very against people's expectations. But it's because last year we had 3 to 4 times the normal amendments for private credit as an asset class. So those are delayed defaults because you can't amend and pretend forever, and the longer rates stay where they are, the more people are going to have to make real decisions around those credits.
Both of you are interested in some sort of rescue financing, distressed investing. What does that look like at a time where the distress is kind of hidden and it's sort of hard to know exactly what's a good opportunity versus a company that hasn't truly been tested yet?
Yeah, I would just say in general, as private credit becomes a more prevalent asset class, there are a few things I would look for in your manager broadly, and it's true to rescue, and then I'll turn over to you, and I'm happy to talk about some of our investments specifically in rescue. But the first is looking for people who have long track records. So long track records are better than shorter ones. So you ideally want to invest with people who have been through a couple of recessions. I know we have a 23-year track record of doing it, and all of our MDs have invested in this asset class since before the financial crisis. The second is actually being conservative. So we've talked about debt levels, but just to give people a sense, if you focus on deployment over discipline, you're going to have not only given up the covenant, but you're going to have underwritten very high debt levels. And we have underwritten to 3 to 4 times debt to EBITDA, and I don't think the market's probably been there since 2012. So that's something to look for. And I'll tie this back to rescue in a second. And the third is diversification, which we haven't talked about. I just want to highlight to people that our clients, are LPs in general, are waking up to the fact that they're in a lot of the same loans. So we have a lot of the same managers when they go and look at, and there's a default issue. No one cared about this when companies weren't defaulting. But now that we're going to have defaults, people are waking up to the fact that they're in managers that have underwritten the same company. And it happens, it's a more tightly syndicated market than private equity. So it's unusual to have lots of the same private equity investments across your managers, but we're going to find out that that's true in credit. And we really pride ourselves at TCW as providing a diversified credit to our clients because of being very focused on the middle market area, staying away. We had stayed away from healthcare and technology and just provided diversified credit to the portfolio. So I want to say that those are things that people focus on. On rescue, in general, this is going to be, in our view, one of the greatest opportunities of the next decade is to come in as a private investor and provide capital solutions to companies that are struggling, not necessarily because they have a fundamental problem, and you would even have more perspective on that. You have a very storied history in distressed investing, but because they have a math problem. And so we have an unbelievable pipeline of companies to provide rescue finance for, and I think you're not going to see a pitch this wide for a long time.
Yeah, rescue financings for us are when a company meets a financial obligation of some form that they can no longer address the syndicated market, either the syndicated high yield or the syndicated leveraged loan market. At that point, they have to turn to an alternative provider. And then at that point, that you can negotiate terms that are more advantageous than what is normal. I'd say that rescue financing opportunity is made better by the fact of the documentation. It's the flip side of what we just discussed, which is that if you're willing to step in and provide a solution to the sponsor when they're looking for a bridge to a better day to get across some operational issues, you can do that on highly advantaged terms. And in our mind, I would completely concur with Katie. I think that is a very substantial opportunity in front of us. It's not like anything I've seen in my career. You're able to structure something that is advantaged in almost all respects relative to the existing capital structure and do it on very good terms. So we're pretty excited.
I'm just going to pick up on that and say whether we talked about public markets all the way to rescue, the main advice to clients is there's going to be an opportunity here to be a liquidity provider. And you want to be positioned in such a way that you can do that. Clearly in rescue finance or private, you can dictate more of your own terms. But even in public markets, you want to step in when others can't. And I do just want to say on liquidity, in public markets, we are going to have a problem with liquidity. Banks are able to hold as 70% as much inventory as they were pre-GFC, and the market has tripled. So whenever this event comes that we're kind of talking about here, there is going to be a liquidity crisis, I think, around that. And therein lies the opportunity for people who have stayed conservative, stayed liquid, and are able to step in and be that provider to public markets. And there's going to be a tremendous opportunity to do that in private markets, too.
So we're completely out of time. Yeah. But, Bob, I want to give you the last word. Are you in this place also where you are conservatively structured so that you could be a liquidity provider?
Yeah, I think what we look for is to be in a position where we can be countercyclical, where the market, and if you look at the average portfolio, it's a very pro-cyclical portfolio. We've had 15 years of just tremendous performance out of pro-cyclical assets, especially leveraged pro-cyclical assets. And I think there'll come a point in time, it's been delayed longer than I would have expected, but I do think there'll be a point in time where being countercyclical will definitely inure to the benefit of that counterparty. So.